A woman paid every bill on time for 11 years, never missed a payment, carried a balance because her financial advisor told her a little debt was healthy for her score, paid hundreds in interest every year to protect a three-digit number she barely understood. Then she applied for a mortgage, got approved at a great rate, and thought she'd finally beaten the game. 10 years later, she's paid $48,000 in interest on that mortgage, plus another $14,000 on rotating credit card balances she kept to maintain her score, plus $900 in annual fees on 3 cards she never really used. The system told her she was winning the whole time. Another guy spent 2 years obsessing over his credit score, hit 800, felt invincible, used that 800 to take on a car loan, a personal loan, and a rewards card with a $25,000 limit. His score stayed high. His net worth went backwards every single month. Third person, a friend of mine, paid cash for everything for 5 years. No credit cards, no loans. Credit score dropped to 620 because he wasn't playing. Every financial institution treated him like a risk. He was the most financially secure person in any room he walked into. What's the pattern? They all trusted the same system, a system that was never designed to measure your financial health. It was designed to measure how profitable you are to lenders. My name is Mano, and I spend way too much time reading the fine print that credit bureaus, banks, and mortgage lenders would rather you never found. If you're someone who has been doing everything the credit score system told you to do and still feels like you're falling behind, subscribe and like this video. It will help more than you think. Here's what we're actually doing today. I'm going to show you exactly how the credit score algorithm was built, who built it, and why the incentives guarantee it optimizes for lender profit, not your financial freedom. I'll walk you through the debt treadmill, the specific mechanism that keeps high credit score people paying interest indefinitely without ever realizing it. I'll explain what I call the utilization trap, how chasing the perfect score literally forces you to carry debt. And I'll give you the 5-step protocol that lets you use credit as a tool without letting it use you. This isn't a rant against debt. Debt is a lever, but right now the lever is pointed at someone else's wallet. Think of your financial life as a plumbing system. Income is the water flowing in. Expenses are the water flowing out. Wealth is what stays in the pipes. A credit score is not a measure of how much water is in your pipes. It's a measure of how many faucets you have open and how consistently you're running them. The banks don't make money when your pipes are full. They make money when the water keeps moving through their faucets. A high credit score, by design, means you are an active, reliable faucet. It says nothing about whether your pipes are filling up or running dry. That distinction is the most expensive financial lesson most people never learn. Here's where this system came from. In the early 1900s, lending was largely local. You walked into a bank, the banker knew your father. He knew if you paid your debts. The entire system ran on human judgment, personal relationships, which was both its strength and its massive flaw. Banks redlined entire neighborhoods based on race and class, so there was a real problem that needed a real solution. Enter Bill Fair and Earl Isaac, 2 engineers, San Jose, 1956. They founded a company called Fair and Isaac Company. You know it today as FICO. Their pitch was elegant. Replace human bias with math. Assign every borrower a score based on objective behavioral data. Banks could lend faster to more people with less prejudice. On paper, this was progress. The intent was genuinely good. Here's who won: the banks. Here's who lost: anyone who trusted the number itself. By the 1980s, FICO had struck deals with every major lender in the country. The score was being used to price interest rates on mortgages, car loans, credit cards. But here's the thing about building a scoring algorithm that banks pay for. You optimize the algorithm for the customer who's paying you, and the customers paying FICO are lenders, not borrowers. In 2023, FICO generated over $1.6 billion in revenue, Almost none of it came from individual consumers. It came from the financial institutions who buy access to your score to make lending decisions. The score was designed by a business that serves banks. To be shocked that it optimizes for bank profitability rather than your financial health is like being shocked that a McDonald's calorie counter was designed by McDonald's. So what does this have to do with the advice you've been following your whole adult life? Everything. Let me give you the actual numbers on how the credit score algorithm works. Your FICO score is made up of 5 factors. Payment history is 35% of your score. Amounts owed is 30%. Length of credit history is 15%. Credit mix is 10%. New credit is 10%. Looks reasonable until you understand what each factor is actually measuring. Payment history measures whether you paid a lender on time. Good, that makes sense. Length of credit history rewards you for keeping accounts open for years, even if they're useless. That one benefits you only because it benefits lenders. A long-term account is predictable revenue. Credit mix rewards you for having multiple types of debt simultaneously. A mortgage, a car loan, a credit card, maybe a personal loan. Think about that. You are rewarded with a high credit score for carrying more debt at the same time. You are not rewarded for having zero debt. You are not rewarded for having a full savings account. You are penalized for paying everything off and closing accounts. Here's the part nobody talks about. The amounts owed category, the second biggest factor at 30%, measures something called utilization. That's the percentage of your available credit that you're using at any given time. Most financial advice says keep it under 30%, but here's what that actually means in practice. If you have a credit card with a $10,000 limit and you want a high score, you need to carry a balance. Not a paid-off card, a balance. Most high score advice recommends keeping somewhere between 1 and 10% utilization. That means on a $10,000 card, you want to owe between $100 and $1,000 at statement close every single month. So you're paying interest every single month, even if it's only $15 or $20, just to maintain the score. That's the utilization trap. The system is not rewarding you for financial discipline. It is rewarding you for consistent, low-level, perpetual debt servicing. The faucet stays open. The bank keeps getting their water. Now, let me run the actual math on what the utilization trap costs you over a lifetime. Let's say you're playing the score game perfectly. You've got 3 cards, each with $10,000 limits. You keep each at 7% utilization to stay in the prime scoring zone. That's $700 per card at statement close, $2,100 total revolving balance. Average credit card interest rate in 2026 is around 24% APR. Even if you pay most of it each month, if you're routinely carrying even $500 in average monthly balance across your cards, you're paying roughly $120 a year in interest. Sounds small. Here's the kicker. Instead of paying that $120 in interest, if you invested it in the S&P 500 over 30 years at 7% real returns, that's $11,500. In context of a 30-year financial life, $120 a year is not the problem. The behavior pattern it creates is. Because it's not $120, it's $120 plus the credit card you opened to optimize your utilization ratio, plus the car loan you kept longer than needed to maintain your mix, plus the rewards card that trained you to swipe for points and think in categories instead of totals. Here's where it gets really interesting. There's a second level to this system that almost nobody explains. Your credit score doesn't just determine whether you get a loan, it determines the price of the loan. A person with a 760 FICO borrowing $400,000 for a home at today's rates might get a 6.8% mortgage. A person with a 680 FICO might get 7.6%. That difference of 0.8 percentage points on a 30-year, $400,000 mortgage is not a rounding error. It's $74,000 in total interest over the life of the loan. So the borrower who paid slightly more interest on credit cards to keep their score up paid less for the mortgage. That math sometimes works out in their favor. I'm not here to tell you credit scores are pure evil. I'm here to tell you they're a tool with a specific purpose, built by a specific industry, and you should understand what you're actually optimizing for before you optimize for it. Let me give you a concrete example. David is 38, has a 790 credit score, very proud of it, has a mortgage at 6.5%, a car loan at 4.9%, and 2 credit cards he cycles to maintain his utilization ratio. His monthly payments on just a mortgage and car are $2,900. His take-home income is $7,800 a month. After mortgage, car, utilities, groceries, and insurance, he has $1,400 left over. He invests $600 a month. He's doing fine on paper. His financial advisor says he's on track. But David has $48,000 left on the car loan and mortgage combined over the next 5 years. If he'd bought a used car for cash instead of financing a new one, he'd have freed up $480 a month. That's $5,760 a year. Over 5 years, $28,800 in car payments that didn't go to his investment account. At 7%, compounding over 20 years, those payments become $110,000 in retirement wealth he doesn't have. He chose the car loan because it helped his credit mix. He paid $110,000 in future wealth for a 15-point bump on a 3-digit number. Now take Linda, same income as David. She drove a used Honda she paid cash for. No car loan, no car payment, no credit mix bump. Invested $480 more per month for 20 years. Same 7% return. She has $253,000 more than David at retirement. Her credit score never broke 730. She didn't care. When she was ready to buy a house, her credit score qualified her for a rate that was 0.4 points higher than David's. Over 30 years on a $300,000 mortgage, that cost her $24,000 extra. She still came out $229,000 ahead because she never let the score manage her decisions. Linda didn't look as financially sophisticated as David on the surface. David had the better score. Linda had the better outcome. Mock dialogue time. You're sitting across from your bank's financial wellness advisor. This is a real job title banks use. I want to start paying off all my credit cards and closing the accounts. Advisor, oh, I wouldn't do that. You'll hurt your credit score. But I'd save $200 a month in interest and fees. Advisor, yes, but you'll lose the length of credit history and increase your utilization ratio on your remaining cards. Can I just pay everything off and invest the money instead? Advisor, you could, but without active credit, you'll find it hard to borrow in the future. I don't want to borrow anything. I want to own everything outright. Long pause. Advisor, well, everyone needs credit eventually. For what? Another long pause. The thing about that advisor is they're not evil. They're operating in a system where their job is to keep you using the bank's products. They're not wrong that the score system works the way they described. They're just not telling you the full picture. It's not a conspiracy. It's just incentives. The bank makes money when you borrow. The credit bureau makes money when lenders query your score. The advisor's job is to serve the bank. Your job is to serve your future self. Those are not the same job. Here's the part nobody talks about. There's a psychological mechanism at work in the credit score system that's more insidious than any individual fee or interest charge. It's the gamification of debt. FICO scores behave like a game. They have a scale, 300 to 850. There are clear thresholds: subprime, fair, good, very good, exceptional. Everyone knows 750 is a goal. Hitting 800 feels like an achievement. Our brains evolved to chase scores and status signals. We're wired to play games. The credit system exploits that exactly. People spend real time optimizing a 3-digit number that measures their value to lenders, not to themselves. I've talked to people who feel genuine pride about their credit score, genuine shame if it drops, as if that number reflects their worth as a human being instead of their profitability as a borrower. That emotional attachment is manufactured by a system that benefits from it. The invisible millionaire archetype, the person who owns everything outright, has no flashy debt, has a mediocre or even poor credit score, and is quietly accumulating real wealth. That person gets treated like a financial failure at the car dealership, the apartment complex, the bank. But at the level that actually matters, net worth, cash flow, actual freedom, they're winning. They just don't look like it because the game we're all watching is the wrong game. There's also a second psychological trap built into the reward structure. Credit cards that optimize for score gaming often come with rewards programs, points, miles, cash back. The research on this is pretty clear. Reward programs train people to spend more to capture points. People who pay attention to rewards points spend more per transaction than people who don't, and the annual fees on premium rewards cards typically require between $5,000 and $10,000 in spending per year just to break even. The rewards are real. The psychological cost of being a points chaser is also real. When your mental model of a purchase shifts from "what does this cost me" to "what points do I get," you have successfully been turned into a high utilization customer, which is exactly what the bank designed the reward program to do. Here's the protocol. 5 steps you can start tonight. Action step 1. Audit what your credit score is actually costing you, not what it's giving you, what it's costing you. Open up your last 3 months of credit card statements. Add up every dollar in interest and fees. Multiply by 12 for the annual figure. Then use the compound interest formula to find out what that same amount would be worth in 30 years invested at 7%. Use 30 as your exponent. For most people, this number is somewhere between $20,000 and $200,000 in lost wealth. It's not the interest that should bother you. It's the opportunity cost of what that money could have been. Action step 2. Stop chasing utilization. If you have no high-interest debt, the single most impactful thing you can do is pay your balances to 0 every month and stop worrying about what your score does in the short term. Yes, it might drop 20 to 40 points if you pay everything off. That does not matter, unless you're applying for a major loan in the next 90 days. A credit score that you're not using is irrelevant. Your net worth is not irrelevant. Protect the number that matters. This is not market timing. This is math. Action step 3. Understand the 2 legitimate uses of credit and stick to them. Credit is a useful tool for exactly 2 things. 1. Major fixed-rate purchases where the total interest cost over the life of the loan is less than the return you would earn investing that same cash. A 6% mortgage in a market where real estate appreciates and you get the mortgage interest deduction, yes, that math can work. A 24% revolving credit card balance that you carry to boost your utilization score, no, that math does not work. 2. Emergencies that exceed your cash reserves. That's it. Not rewards optimization, not maintaining your credit mix, not proving something to a lender you've never met. When credit is a tool you use on purpose for calculated reasons, it's powerful. When it's a score you optimize because the system told you to, it's a slow drain on your future. Here's how you build your real financial score, not the one FICO calculates, yours. Track 4 numbers monthly. Savings rate, what percentage of your take-home pay did you invest this month? Net worth, total assets minus total liabilities, all debts subtracted. Passive income ratio, income from investments or rental divided by monthly expenses. And cash buffer, how many months of expenses you have liquid and accessible. These 4 numbers tell you more about your financial freedom than any credit score ever will. When the savings rate is over 20% and climbing, when net worth is growing, when passive income is covering a real percentage of expenses, and when the cash buffer is 6 months or more, you are financially strong by every measure that actually matters. Action step 5. Know when your credit score actually matters and prepare for those moments in advance. If you plan to buy a house in the next 18 months, yes, optimize your score now. Pay down revolving balances, don't open new accounts, don't close old ones, request a credit limit increase on your oldest card without spending more. Do the credit score dance for that specific 18-month window, then stop. That's it. That's the legitimate use case. Use the system deliberately for a defined purpose. Don't live inside it indefinitely as a lifestyle. Here are your 3 takeaways. 1. Your credit score measures how valuable you are to lenders, not how financially healthy you are. Every optimization you make for the score should be evaluated against what it costs you in actual dollars, not points. 2. The utilization trap is the mechanism that keeps high-score people paying interest indefinitely. Carrying a balance, even a small one, because the algorithm tells you to, is paying a fee to play a game that someone else designed for their benefit. 3. Build your real financial score: savings rate, net worth, passive income ratio, and cash buffer. When those 4 numbers are moving in the right direction, the FICO score takes care of itself for the only moments it actually matters. You are not a passenger in this system. You are the product. The credit score industry turns your financial behavior into a product it sells to banks who use it to extract more money from you over a lifetime. That doesn't mean you avoid it or fight it. It means you understand it clearly enough to use it when it serves you and ignore it when it doesn't. The invisible millionaire doesn't have an 850 credit score. They have options. That's the only score worth chasing.